Okay, taking a look at Christiana Clothing Co. This is a retail store that is gifting certificates that are redeemable in merchandise. So the gift certificates lapse 1 year after they're issued. We want to know, how would the deferred revenue account be affected by each of the following? So the initial journal entry would be cash received for this gift certificate. So we would have a debit to cash and a credit to unearned revenue, right? So let's say a customer is paying Christiana Clothing Co. for this gift card and they intend to use it at a later date. So technically, that is a performance obligation to Christiana, right? They're saying, cool, we have this cash today, but we owe them this clothing merchandise later. That obligation to give the customer their merchandise at a later date is going to be classified as a liability today to the company. Okay, so therefore, when the gift card is purchased today, right, the transaction occurs and the customer is buying that gift certificate today, deferred revenue would be recognized today. So it would increase because the revenue will not be recognized until Christiana Clothing Co. has earned the money. So under scenario 1, the redemption of certificates occurred. So basically we're saying here that the customer cashed in that gift certificate and is now applying this to acquire merchandise. Okay, so now the revenue has become earned. So we're going to reverse out the unearned revenue right now because it's earned. So this would now be debited and we would credit revenue that is now earned. And what about if certificates lapse? Same story, right? If certificates lapse, this is no longer going to be a performance obligation to the company. Okay, so we'd have a debit to unearned revenue and a credit to revenue, right? This is still cash we get to keep. So therefore, by selling that gift certificate, it has now been earned, right? Just because the customer didn't have the presence of mind to go back and cash in this gift certificate and now it is no longer usable because it's lapsed, it's not like they're going to get their money back. So that's money that the company still gets to keep. So they have to recognize this, and they're going to recognize it now as revenue. Okay, so regardless, at the end of the day, deferred revenue would be decreased under both situations, right? Deferred revenue, aka unearned revenue, is getting reversed in both situations. Therefore, decrease and decrease would be the best answer choice.
Equivalents have a maturity of 3 months or less.
Okay, nothing too crazy here. We just want to know which of the following most accurately reflects a true statement regarding a seller that is recognizing revenue. Okay, so the best way to do this is just going down the line. The transfer of physical possession of an asset reflects revenue being recognized over time. By transferring over this asset, it is assumed that we are making this one-time lump sum transfer. Okay, so this is going to be revenue that is recognized at a point in time when the transfer is made, not over a period of time, right? There aren't multiple distributions or multiple transfers that are occurring here. Okay, next up, rent that is unearned by a landlord for rent over the next 9 months would be recorded as a long-term liability. Okay, so the key time to note is 9 months, right? If this was going to be recognized over 12 months, then it would be a long-term liability. But because this is rent that is being recognized over the next 9 months, it would be recorded as a current liability, right? This would be short term. A customer having legal title to an asset will reflect control, which indicates revenue is being recognized at a specific point in time. This is absolutely correct. All right, so once the customer now has complete control of the asset by obtaining this legal title, this will indicate that the revenue is recognized at a specific point in time, like we said, when the transfer is made. Okay, so if this, on the other hand, was legal title being passed to the customer over a series of transfer times, then it would be over a period of time, not at a specific point in time. All right, so little miscellaneous details to pay attention to. And finally, this last answer choice would be incorrect. When a company has multiple services that are all similar in nature and can be provided in a similar manner, they must be split apart into distinct components. That is incorrect. If on the exam you see anything that says similar in nature related to multiple contracts, then they could be all allocated into one contract, right? So at their option, they can be combined into one single performance obligation. So that's why this isn't necessarily true. Okay, so on the surface, this might look like an easy question, and in reality, it might be an easy question, but it is very important and something that we need to know. Big difference between accrual accounting and cash accounting. We are going to apply accrual accounting when it comes to US GAAP financial reporting. And when you think about accrual accounting, one of the fundamental concepts is that revenues and gains will be recognized when both realized and earned. So realized just means that cash has been received, or the equivalent to cash, right? Payment or consideration has been received. And it is also earned when the performance obligation has been fulfilled. Okay, so very important to note that it also must be earned. This is what's key to understanding revenue recognition under accrual accounting. Okay, so the transaction price is the price within that contract amount that the company expects to receive from a customer. Okay, this is the amount we're charging for our goods or services. All right, but there are some additional outside considerations that need to be made. Okay, so it's not always going to be so black and white. So some of the most common types of consideration included in the price that we've seen on the exam in the past consist of variable consideration, which basically means that this would be contingent on a future event, something like a bonus. Non-cash consideration, so this is anything that is other than cash fixed into that price. So this could be a bartering agreement, right? Trading tangible property or goods. Okay, so this can also be something like a financing component, all right? This isn't an option within this question, but if this was financed from debt or equity, that should also be considered. And finally, consideration payable to the customer. So this could be something like a discount or a refund, right? Something that is being paid back to the customer should be considered. All right, so while the overall return on investment is an important thought, it is not one of the primary considerations within the transaction price. Okay, so at the end of the day, this is the best answer choice for this question. Okay, so Fulton & Co. has a $9 million construction contract that they entered into. So we have additional information related to their costs, we have some information related to their billings and the cash that they collected. But what are they looking for? They're looking for the amount that is reported as a current liability. Now, the general rule is that anytime accumulated costs is greater than progress billings, it's going to result in a current asset, not a current liability. Okay, so although that's what we mentioned in our lecture, technically it's accumulated costs plus any estimated earnings. All right, that's the high level understanding. If we really want to drill into the details, accumulated costs plus estimated earnings is ultimately what is getting compared to progress billings. So this is about as crazy as it's going to get. All right, but we know right out of the gate that accumulated cost is greater than progress billings. They want to know what amount is getting reported as a current liability. This would be reported as a current asset. So none of this is going to be reported as a current liability. The answer would be 0. Okay, so what do they mean when they say estimated earnings? Well, that's just taking the total cost incurred to date divided by the total estimated cost, right? That's the 25% percentage completed. And we know that the gross profit is 1 million, right? We had revenue of 9 million, estimated cost of 8 million. So the gross profit would now be multiplied by 25%. So the current year estimated earnings would be 250,000. All right, we already know that the answer is 0 because 2 million is greater than 1.8 million. Okay, but if we added the 2 million even further to 250,000, 2,250,000 would be even greater than that previous amount. All right, so long story short, the answer here is 0. This should not be reported as a current liability. It should be reported as a current asset. If for whatever reason progress billings was 2.5 million, then this would be reported as a current liability. Okay, so we got to remember, if progress billings is the greater amount, then this would be reported as a current liability. Not the case here. So the answer is going to be 0.